So thank you all for joining me today. So my name is Carla Smart from Skybound Wealth Management, and I'm joined by Sarah Meriguet from Vietnam. Hi, Sarah. How are you doing?
Hi. Hello, everyone. Good afternoon.
So for those of you who are either living in France at the moment or planning to retire in France, Sarah and I will be covering off all of the essential areas that you should be considering from a tax and financial planning point of view. So just to run through the agenda, I will start by giving just a brief introduction to myself and Skybound before passing you across to Sarah, who will be introducing herself and Vietnam. Sarah will be just touching on the changes in law that came into place regarding forced heirship in France and the tax implications of this, and then covering some of the basic rules of inheritance in France. She'll be talking about some of the things you need to be aware of in order to minimize your French inheritance tax liability. And then we'll be discussing together some tax planning tools and investment solutions which are available in France. We'll then be looking at how to draw down, for those of you with a UK pension, how you can draw down from this in a tax efficient manner in France. And we will be finishing with a case study, which should hopefully bring everything together that we've been discussing throughout the presentation. Okay, and yes, we should be available for any questions that you may have at the end of the presentation. So I began my career in London and was fortunate to have some time spent in Buenos Aires, Barcelona and Paris before moving to the Geneva area to join Skybound, who were known as GWM at the time, back in 2013. I have two roles within the organization. So I am a chartered financial planner. So I have my own clients that I service and look after. But in addition to that, I am Skybound's pensions manager. So I provide my technical support and assistance to my colleagues and their clients in relation to pensions. Now, as a company, we began as GWM around about 25 years ago, and we were acquired by Skybound Capital back in 2020. So following the acquisition, GWM rebranded, changed our name to Skybound Wealth Management at the beginning of 2021. And we have since been going through a period of expansion and growth, strengthening our existing client proposition. We are a completely independent company, so we are not tied to any one product. We're not tied to any one provider. We are completely free to look across the whole marketplace. You can see here in terms of our global presence, where our current offices are situated, our expansion plans, where our parent group, Skybound Capital, are based, along with our partners. So these are other companies within the Skybound group. We are fully regulated in the jurisdictions in which we operate, and most recently we obtained the Cypriot license, which allows us to grow our presence in Europe. In terms of what we actually do as a company, essentially we are financial planners. So it's our job to understand what our clients have, what our clients are looking to achieve, whether that's planning for their children's education, planning for their retirement, buying a house. Once we understand what their objectives are, we can then identify perhaps any shortfalls that may exist and help our clients to then put a plan in place in order to meet their goals. We were delighted last year, back in 2021, to be awarded a number of awards at the International Best Advisor Awards, including Best Advisor Firm in Europe. In order to be nominated, we had to submit a case which covered off a number of areas in relation to the company, the assets that we have under management, our staff, their qualifications, the range of products we have available, our client feedback, client retention, reviews, and so on, amongst many other things. So it's something that we are immensely proud of in order to have been recognised in this way. Okay, if I pass over to you now, Sarah.
Okay, thanks, Carla. So on my side, I'm a senior tax advisor working at Fidinam for over 6 years now, including 4 based in Hong Kong. So during these years, I have advised clients on their French and international tax issues, including wealth management, private investment, and estate planning. So as you may have noticed, I'm a French qualified lawyer, and before joining the group, I worked in various leading law firms in France, and more precisely in Lyon, which is my initial hometown. So I will present now the group Fidinam. So talking about Fidinam, so the group is a private global consulting firm founded in 1960 in Lugano, so in Switzerland. So we offer a range of value-added consultancy services to companies, entrepreneurs, and individuals. Tax consulting is the core business of our company, and we cover any aspect of tax and assisting private and corporate clients. Some key figures: we are about 250 consultants in 30 offices, and we are active in over 90 countries around the world for our physical presence and our extensive network of correspondents. So maybe let's talk about the French succession law and the recent changes. Firstly, I just want to present briefly the basis of the French succession law. Bear in mind that French succession are governed by the principle of the forced heirship, meaning that the testator has no full control over the distribution of his assets and must leave a proportion of it to the children. So children are reserved heirs according to the law and must inherit between 50 to 75% of the estate, depending on the circumstances. So as you can see, by contrast, common law allows the freedom of testamentary disposition. Individuals are broadly free to deal with their property as they wish and have. So this is really a main difference between the French and the UK system. International successions in France are also governed by the European succession regulation, which states that the applicable inheritance law is the one of the country where the deceased has his habitual residence at the time of death, with the possibility to elect for the law of nationality. So if the last residence was in France, for example, then the French succession law will apply to the worldwide assets of the estate, excluding, of course, in principle, the real estate located outside France. So if a UK deceased was a French resident at time of death, then the French law applies to this succession, and therefore he will be bound by the forced heirship rules, unless he has elected for the law of his British nationality to apply to this succession. So in this case, he could benefit from the UK law and decide to leave all of his assets to his wife. So given this situation, the French succession law has been amended recently in 2021 with a new article of the French Civil Code, which in essence allows beneficiaries of a deceased French person to enforce their heirship rights by claiming against any assets located in France. So it means that if you elect for the UK law to apply to your succession, however, you are still subject to the heirship force for the asset located in France. So this law creates uncertainty in estate planning for international individuals with French links, and it's also controversial as it conflicts with European succession law. And for this reason, it is expected that this new law will be challenged in front of the European Court. So it must be followed, but for the moment and currently, you need to take into consideration this new rule if you opt for the UK succession law while you are still residing in France. So let's now give an overview of the French inheritance tax. So firstly, what you need to know is that the application of the French inheritance tax depends mainly on the status of residency of the deceased and the heirs. Let me explain. French inheritance tax applies on worldwide assets as soon as the deceased was tax resident, or, and this is really particular to French system, the beneficiary has been French resident for at least 6 continuous years of the last 10 years preceding the death. If no one, so meaning no heirs, the heir and the testator were not resident in France, then the French inheritance tax will apply only on the French assets. So the scope of French inheritance tax is very extensive and mainly depends on the residency of the deceased and the heirs. And the problem is that under the French domestic law, the criteria for determining the tax residency are also very broad. According to the Article 4B of the French General Tax Code, individuals are considered as a French tax resident in any one of the following circumstances. Either they have their household in France or primary place of residence in France, or they perform in France a principal professional activity, salary or not. Also, it's important to note that an executive of company with a headquarters in France with turnover over 250 million euros is also considered as resident. And lastly, if they have their economic center of interest in France. So there's 4 criteria are alternative, and this applies to the inheritance tax, but also to the income tax. So as soon as you meet one of these criteria, you could be considered as a French resident, and then the taxation will apply on your worldwide assets. So this situation could potentially lead to double taxation, particularly if the deceased is also considered as a resident in another country, and if one of the heirs is domiciled in France. Hopefully, France has signed double tax agreement to avoid this double taxation on inheritance. This is very useful, and if we take the example of the UK, there is a double tax treaty, which has been signed in 1963, and which provides, in this case, some articles in order to avoid this double taxation, especially if there is a conflict of dual residency. This could be easily the case if the deceased qualifies as a resident in both countries, when, for example, he was a UK domiciled because he maintained a strong link with UK, or he has been relocated in France less than 3 years prior his death. And then he could still qualify as French tax resident. So in order to avoid this double taxation, the treaty gives 4 successive criteria to determine which country has the right to tax the estate. And the first criteria is where the deceased had his permanent home. So this is the first step. Once we determine that French inheritance tax will apply, we need to know how it will work, what is the taxation. So we can go, Carla, on the. Yep. So the liability to French inheritance tax will depend mainly on the taxation rates and allowance, on the family links between the deceased and the heirs. So the spouse and the civil partners bound by a pact are exempted from inheritance tax, while the other heirs are liable with a tax allowance which depends on the family. For example, if it's a children, he has an allowance of 100,000 euro, and above this allowance, there is a progressive rate which applies from 5% to 45%, as you can see in the table that we have included in the presentation. If it's a non-relative, you can see that they have a tax-free allowance of 1,594 euro, and then a flat tax of 60%. And you need to know that partners not bound by a tax or stepchildren are considered as unrelated persons. So this category is really heavily taxed. Hopefully, under French law, there are some attractive tax-efficient inheritance options that you could consider to reduce your estate burden. So without listing all of them and without going into much details, let's take the ones that are most commonly used. The first one is the donation. Donation is an act for which the donator gives part of his inheritance to a third party, a family member or not. In any case, the first heirship must be respected. Otherwise, you need to know that they could challenge the gift if the value exceeds the portion of reserved estate. However, it allows to benefit from the allowance of 100,000 euros, as we mentioned before, which can be renewed every 15 years per children and per parent. There is on the top an allowance of 31,865 euro for cash donation. The donation must be passed in front of a public notary, except for the manual donation, such as cash or jewelry, and any gift must be registered with the French tax authorities. It's taxable upon the donation on the net asset value and calculated at the same graduated rate applying to the inheritance tax that we saw before. The second option is the property dismemberment. So this is the so-called démembrement de propriété. This operation is not usually not recognized in a common law system. So we recommend to consider this option with French assets only, or anyway, you need to consult also a UK advisor. It means that you will divide the attributes of the full ownership between the bare ownership, so the new propriété, which corresponds to the right to dispose of property, and the usufruct, which is the right to use and rent the property, so meaning to earn the income. In France, this is an interesting tool, often used for the real estate held by the family. It aims to ensure protection of the spouse, who will keep the usufruct, while the ownership is given to the children. So they hold the bare ownership. And upon parents' death, the usufruct right is automatically transferred to the children without any tax. So there is a tax interest to make this operation. The bare ownership corresponds to a fraction of the property only, and the gift tax base is then reduced. The value of the usufruct is calculated on the basis of age at the time the parents give the bare ownership. So let's take an example. If the parents are between 70 to 80 years old at the time the bare ownership is given to the children, then the value of usufruct is 30%, and the taxable bare ownership is only 70% of the full ownership. So the children will be taxed, the estate will be taxed at 70% only. And at death, the children will not have to pay an inheritance tax at the expiration of the usufruct. Of course, if you have any question on this complicated scheme, you may ask. And then, so the third option, this is the dutrail transmission agreement. In France, we call it the Pacte Dutrail. This scheme is used to transfer a family business and allows a tax reduction of 75% on the value of the business. And you just need to bear in mind that to simplify the transfer procedures, the scheme has been relaxed under the Finance Act for 2019, but it's still subject to strict requirements in order to benefit from the 75% reduction. So it's also applicable on foreign businesses. So it means that if you have a business in UK, you could consider to, and if you are a resident in France, of course, you could consider to set up a detailed agreement. Of course, other juridical consideration in France, but we couldn't discuss all of them here, but you need to think about a French matrimonial regime, a will, or a tontine. One thing as well, for those who are not already arrived in France, so not already tax domiciled in France, we advise to set up a pre-entry planning strategy as far as possible. For example, if we take the trust, which is frequently used in the Anglo-Saxon world to pass on assets to future generations, it's not recognized in France. So if you have one before you come to France, you need to make sure that your trust complies with the reserved rules that we mentioned before. And also, you need to understand that there is no tax advantage in France on the trust. And also, this implies several reporting obligations on the beneficiary, on the settlor. So you really need to be careful with this vehicle when you are resident in France. And if possible, and if it's interesting, you could also consider prior to relocate in France to realize the foreign income source or the latent capital gains, if it's, of course, more interesting. So another tool which represents an attractive saving option is the life insurance. In France, we call it the assurance vie. So of course, this tool grants fiscal advantage. And for instance, payouts to beneficiaries are excluded from inheritance related taxation according to the French law. So this, the funds will follow a special tax regime. Life insurance policy in France are also exempt from the strict French succession rules that we exposed before. So it means that if you can leave the capital to whomever you wish with one limit, which is the premium that needs to be not considered like excessive. So a premium may be considered as excessive according to circumstances such as the age, the family, or the financial situation of the subscriber. So you need to pay attention at this point. But generally, you can keep in mind that it protects from the inheritance tax, even if the asset is passed to a non-blood relative. This is the main point with the life insurance. And talking about the tax regime, so it applies as long as the policyholder or the beneficiary is considered as French resident, even if it's a foreign life insurance, for example, a Luxembourg policy. You need to consider as well that there is no wealth tax. The funds remaining within the life insurance grow free of tax as well, without any limit on the amount that can be invested. And on the withdrawals, only the growth is taxed as follows. So 12.8% of tax, income tax for the withdrawal made before 8 years, or if the withdrawal is over 150,000 euros after 8 years, plus 17.2% of social charges. So it brings to 30%. And then if the withdrawal is less than 150,000 euros, you have a reduced tax rate at 7.5%. plus the social charges at 17.2%. So this is if the life insurance are held after 8 years. You need also to consider the tax-free allowance if you are a resident in France of 4,600 euros for a single person and 9,200 euros for a married couple. And if you want to pass your life insurance policy to your heirs, beneficiaries, the taxation rate is as follows. So the premium paid before 70 years old, there is an allowance of 152,500 per beneficiary. And then it's taxable at 20% for the amount up to 700,000 euros. And over that, it's 25%. And premium paid after 70 years old, there is a tax-free allowance of 30,500 euro only. So what you just need to bear in mind is that the taxation will vary depending on your age at the time you pay the premium. As you can see, it's more advantageous if you pay it before 70 years old. So the life insurance in France, as we mentioned, so it's a good estate planning tool. It offers good flexibility and the freedom to draft the beneficiary clause, allowing the transfer of assets to be tailored as closely as possible to the wishes of the policyholders. Beneficiary clauses are very important to enjoy the benefits of a specific tax regime at the time of death. If no such clause, the policy is valid, but the policyholder is then subject to civil and tax rules of the succession. So you really need to pay attention to the drafting of the beneficiary clause. You also have various options to choose to write the beneficiary. We recommend you to clearly identify the beneficiary to avoid nominating a single beneficiary. Otherwise, it's subject to general succession law. So to have a precise and complete beneficiary, it's really important. And of course, the beneficiary clause can be changed several times until death of the insured person. And the beneficiary can choose between different options. So, for example, he could receive a defined percentage of an estate or full ownership, or also the usufruct. And we already talked about the démembrement de propriété. And this is a good tool as well to combine with the benefit of the life insurance. It could be really interesting, especially when you have several beneficiaries and you want to protect one with giving him the usufruct, so to receive the income of the life insurance policy, and the others to receive the bare ownership. And now I'll let Carla to explain more in detail what is life insurance policies.
Okay, thank you very much, Sarah. So yeah, if you are living in France and planning to be here for the long term or planning to retire in France, an insurance fee should be a key consideration in your financial planning. Obviously, Sarah has touched on a number of the tax advantages of this type of structure. I'll now come on to talk about the different assurance fee solutions that are available in the marketplace in France. So quite simply, an assurance fee is a structure in which to, a vehicle in which to hold your assets. So you can walk into any bank in France and it's likely that they will have some kind of assurance fee offering. Equally so, it's possible to open an assurance fee outside of France in the likes of Luxembourg, Ireland being popular jurisdictions. And the advantages of benefits of having these solutions will vary depending upon the assurance fee that you actually have. So let's come on to talk about some of the differences that you'll find across different solutions. Now, from a taxation point of view, it's really important that you ensure that the bond or the life assurance contract that you have is compliant. Now, when I say bond, I'm not talking about a government bond or a fixed interest security. I'm talking about a portfolio bond, which again is quite simply a wrapper in which to hold your investments. Now, the assurance fee, in order to be compliant, it needs to be registered, it needs to be based within the European Economic Area. So if you hold or you're planning to open a contract which is based, say, in the Channel Islands or the Isle of Man, then you will not benefit from the tax advantages that Sarah talked about. So it's important to ensure that, yes, it's compliant. So the likes of whether it's Luxembourg Island, you'll have, as Sarah mentioned, the same level of tax advantages to that of a French product. When it comes to investment options, the range of assets typically that can be held in a French assurance fee are not going to be as vast, let's say, as an assurance, as an international assurance fee. They tend to be more restricted. Sometimes if it's through your bank, they may just offer their own sort of in-house funds as opposed to having sort of a whole of market approach, which is fairly typical for an international assurance fee. So in the likes of, say, Luxembourg Island, they tend to be more flexible, more diverse, and obviously diversification does help to reduce risk. So I would recommend that you clearly understand what investment options are available within that assurance fee structure before entering into any kind of a contract, to make sure that, yes, they meet and they're in line with your requirements, your objectives, and of course, your attitude to risk. For currencies, a French assurance fee product will be available in euros, whereas an international assurance fee will offer multiple currencies, which can, of course, be beneficial for anyone who either holds or wants to invest in alternative currencies other than euros. Service, it tends to be, from feedback I have from clients as to their experience with the local French banks, at times it can be one of frustration. With an international assurance fee, you're able to appoint a financial advisor who should be able to deliver you a much more personalized approach. Portability is important. I have to say the majority of Skybound's clients, they either haven't been in their current location all of their lives, or they might not necessarily intend to be there forever. So if you have, say, a British person living in France, and they have an assurance fee that they set up through their local bank in France, if they return to the UK, then they will have to close that account. Whereas if they have an international assurance fee solution in the likes of Luxembourg, they're able to then keep that product as it is, stay invested, and take it back to the UK with them. It's important to note that the policy will need to be, it's called endorsed. It's quite simply a paperwork exercise that your financial advisor should be able to guide you through, just to ensure that it is fully compliant for UK tax purposes. When it comes to cost, this is going to vary depending upon the type of assets that you hold within your structure, within your assurance fee. So if you have someone who appoints a discretionary investment manager to manage the assets within that policy, then quite naturally they're going to be paying more compared to someone who is simply invested in ETFs, tracker funds, which track the market, and there is no management involved there. Again, it's important that you, I mean, for costs, it's not the most important thing when it comes to investing, but it does matter. So it's important that you fully understand exactly what you're paying before entering into any form of contract. The minimum and incremental investment amount is lower in a French assurance fee compared to that of an international one. So depend upon what stage you are at in life. Perhaps if you're at a point where you're accumulating, building wealth, and paying, say, smaller amounts on, say, a regular basis, then perhaps a local French solution could be appropriate. Whereas if you're later on and maybe you've got a lump sum of money to invest, you're looking to preserve the wealth that you have built, then maybe an international assurance fee could be more suitable for you. When it comes to language, for a French assurance fee product, then this will be available in French, including obviously all the literature and so on. Whereas with an international assurance fee, this will also be available in English, which a lot of my clients do find helpful, just so that they are fully aware and understand all of the terms and conditions and so on before entering into any kind of a contract. When it comes to protection, the maximum level of protection with a French assurance fee is 70,000 euros, whereas in Luxembourg, for example, they have a triangle of security, they call it, where the client's assets have to be in a separate, an independent custodian account. So the client's assets are completely ring-fenced. So in the event of failure, a client's assets of the institution, then the client's assets are fully protected. Okay. So that's sort of covering the various different types of assurance fees which are available in the marketplace. We'll now move on to talk about for anyone who holds a UK pension and they're wanting to draw down from this pension in France, how that would be considered from a taxation point of view. So first and foremost, it's important that you consider what type of pension you actually hold. So you may have a defined benefit scheme or a defined contribution scheme. So a defined benefit scheme is also known as a final salary scheme. And this is going to be based on the number of years that you've worked with your previous employer and the final salary that you had when you left. And then you will receive a portion of that income at and through retirement. A defined contribution scheme, also known as a money purchase scheme, is quite simply a pot of money. The employer and the employee contribute to this pot. The pot is then invested, it grows, and then it's designed to provide an income in retirement. Now, if you're French tax resident, you would be taxable on your worldwide income, obviously subject to a double taxation agreement. For the double taxation agreement between the UK and France, most income, so private sector and state pension in consideration of past employment, is taxable in the country of residence, unless of course it's a government services pension, which would then be taxable in the UK. So if you're living in France and you have, say, a military, teachers, local government or police pension, then that would still be taxed in the UK. So let's move on to look at a case study, which should make all of that side of things a little bit clearer. So here we have David Best, who is 63 years old. He is British. He is resident in France and married to Linda, and they have 2 children who are also both resident in France. They have a property in France worth 800,000 euros, a property in the UK that is worth 600,000 pounds, cash of 200,000 euros, and David has a UK SIP worth 500,000 pounds. He is expected to receive a French pension of 40,000 euros per year from age 65 and a UK state pension of 5,000 per year from age 66. So his objectives: he would like to retire in France at age 65. He has no intention to return to the UK. He and Linda would like to have a targeted income of between 50 to 60,000 euros per annum. and he would like to have the ability to take ad hoc withdrawals from his UK pension in order to supplement his existing income. He would like Linda to initially benefit in order to provide her with some protection and for any remaining capital to then be passed on to his children. So if we look at his UK pension, if he were UK resident drawing down from that pension, then he would be entitled to take 25% of that pot as a tax-free lump sum, and the remaining 75% would then be taxed at his marginal rate. Given the fact that he's French resident, we'd first of all need to establish what type of pension scheme it is. So it's a SIP is a self-invested personal pension. It's a type of defined contribution scheme. So this pot, it's a private pension. So it would be taxable in France. So in order for his pension scheme to pay the benefits gross, he would need to apply to HMRC for an NT tax code, a no tax code, so that they pay the benefits gross. The income that he then receives would then be fully taxable in France, and it would be taxed at his marginal rate. So going back to thinking about the other income that he's expected to receive, if he's got his French pension, the UK state pension, based on the tax brackets here, he would then be taxed at 30%. I'll pass over to Sarah, who's going to touch on what the social charges that should also be considered here.
Thanks, Carla. So yes, in addition to the income tax, he will have to pay social charges on the pension income, which depends on the total income and the circumstances. So if we take the case of David, as he's married and will receive more than 36,000 euros, the rate should be the maximum, so 9.1%. And in principle, of course, he is liable to pay the social contribution if he's affiliated to the system of compulsory health insurance in France. So it means that we could be exempted from social charges on the pension income if ever so David holds a S1 portable health certificate, and or if he has a private health policy and is not enrolled in the French social security system. If he has to pay the social charges, he could partially deduct against income tax the CSG previously paid, so at 5.9%, the CSG on the previous years, and yes, before the income tax will be calculated. So once he withdraws the pension, then what happens if he has to pass on this pension to his heirs? As we mentioned, he wishes to firstly to give it to his spouse. As we saw before, there is no inheritance tax between spouses. So the French tax will apply on the second death of the spouse, as it will, so the remaining pension will fall within the estate and would be taxed in line with the tax rate that we saw before. So including the property and the cash and the other potential assets that David has, as it will be a worldwide taxation, the children of David could end up paying tax up to 45%. So this could be heavy. Yeah.
And if we look at the sort of the second option then, as an alternative to going down the first route of withdrawing directly from the SIP.
Yes, so as we mentioned before, if you withdraw on a regular basis, as we saw, the taxation could be high depending on the other revenues of David. Mm-hmm. So hopefully there is one option, which could be interesting in France. This is the application for the lump sum taxation. So in France, you could apply for the taxation as a lump sum, and there is a fixed rate of 7.5% only. This is the so-called prélèvement libératoire. There are some requirements to be met. First of all, David, if he opts for this taxation, must withdraw the full of the lump sum. So it's not possible to divide to withdraw on several times the pension. So it's in one go. Hopefully, as we mentioned also before, there is no wealth tax in France, so he will not be subject to taxation once he withdraw in one go the pension. The second requirement is that the contributions paid by David and his employer were tax deductible. So this is really important as well. It must be deductible when the contributions were done at the time David was working. And lastly, the decision is irrevocable. So in practice, he just has to opt at the time he declares his annual revenue in France. He just has to opt for this lump sum taxation, but he can't go back to his decision once he has submitted basically the tax return. So as we mentioned, there is a flat tax rate of 7.5% and a 10% allowance. If we take the example of David, he receives 500,000 euros. He will be taxed on 90% at 7.5%. So in total, he will pay 33,750 euros, which is really interesting compared to the previous option. As we mentioned before, he could, in the previous option, be taxable at 35% on the 500,000 euros. So, yeah. And in addition to the income tax, there are social charges at 9.1%, as we saw before, and with the same condition of exemption in case he is not enrolled in a French social security system.
And if we look at that from an inheritance tax perspective now.
So yes, so once David receives the lump sum, then the wife could receive the life interest of the policy to provide with some protection. So this is in the case he wants to, once he receives the funds, then he could consider to invest the fund in a private life insurance in France, as we saw before. So he withdraws the funds, he pays the 7.5% plus the social charges at 9.1%, and then he reinvests all the funds in a private life insurance with her wife as a beneficiary of this private life insurance. As we saw also, he could at this time opt for dismemberment of the clause, so a démembrement propriété, and to provide her with some protection, to give her the usufruct and to give to the child the new propriété, so the bare ownership. So the children, as we saw, could also be nominated as underlying beneficiaries. And once they receive the funds, they will have an allowance of 152,500 each on death, yes, with a reduced tax of inheritance, as we saw before.
Yeah. Okay, good. So, I mean, based on this, using this as an example, I think in their situation, the second option would be more suitable for them, to pay the one-off lump sum tax, and then to use the proceeds to put into an insurance fee, because yes, they're resident in France, they have no intentions to return to the UK, and this will help to not only reduce their income tax, but inheritance tax as well. And if possible, prior to actually becoming French tax resident, so anyone who isn't yet that has a UK pension but plans to draw it from France, then it may be worth considering actually taking the pension commensurate lump sum initially in the UK at 0% tax, and subsequently taking the remaining amount as a one-off lump sum in France, before then subsequently obviously investing that into an assurance fee. Okay. Good. Do you have anything further to add on that, Sarah?
No, that's pretty clear for me.
Okay, perfect. Okay, perfect. Well, we have had a few questions that have come in. One of them was in relation to the case study, just wanting to understand what the implications would be for David if his circumstances changed and he then returned to the UK, what the implications would be from an inheritance tax perspective on his UK pension. So as a UK resident that holds a UK pension, then the pension is considered outside of the estate for inheritance tax purposes. So David would be able to pass the full amount on tax-free up until age 75. And then after 75, the beneficiaries would then be taxed at his marginal rate, at their marginal rate, sorry. If he had actually withdrawn the full amount in France and invested into the assurance fee, and then subsequently returned to the UK to become UK tax resident, that assurance fee would then be considered part of his estate for inheritance tax purposes. So he would be able to still pass it on to his spouse, Linda, free of tax, but subsequently anything which is then passed on to the children, then it would be taxed at, it could be at 40%, anything over and above the nil rate band in the UK. Sarah, are there any considerations that need to be thought of from a French tax point of view in that scenario?
Yes, so in case David transfer his tax residency from France to UK, there are some things to consider on the French side. Especially, you need to know that in France, you could be liable on the French exit tax, which is applicable to the individuals who are resident in France during 6 years of the last 10 years prior to their relocation.
Okay. And
this means that they could be taxed on the unrealized capital gains where they hold more than 50% in a company, or if the global value of their stocks or shares exceeds or is equal to 800,000 euro. So this needs really to be considered when you are thinking to go back to your home country in UK. And yeah, because there is a tax impact on this point. Yeah.
And that's if you hold direct as opposed to in an assurance fee policy.
Yes.
Yeah.
Yeah. For an insurance fee policy, sorry, this is not. Yeah, it's not part of it. It's company shares, stocks, investment portfolio, but not life insurance.
Right. Okay.
And then you need to consider, of course, if you are planning to transfer your residency, you need to be careful if you have if you keep maintaining a strong link with France, because as we saw before, there is a different way where you could be considered as a French resident, especially if you keep your economic center of interest in France. Of course, as we saw as well, there is the double tax treaty, which avoid double taxation. But yeah, you need also to consider that you need to effectively transfer your tax residence. And of course, if you leave France, you have some formalities to perform with the French tax authorities. You need to declare your new address and you need to fill a tax return accordingly. Yeah.
Okay, thank you. We have also had some questions around Malta cure-ups. So some people hold a Malta cure-ups. For those of you who don't know what a cure-ups is, it's a qualifying recognised overseas pension scheme. There are a number of benefits to holding this type of structure. It's particularly attractive for those who may have so larger pots and issues with the lifetime allowance charges. But Sarah, we've obviously touched on how a UK pension, so the SIP in this example, is taxed from an income and inheritance tax perspective in France. It was mentioned a multi-cure-ups, and I suspect that the majority of people who have a cure-ups in France are going to have a multi-cure-ups. How would this be considered from a tax perspective? Would it be the same, or would there be any differences?
Basically, it should be the same as long as, so if they still can opt for the lump sum taxation, as long as they meet the requirements that we mentioned before, meaning they must withdraw full lump sum. Mm-hmm. The contribution should have been tax deductible, and the decision must be irrevocable. So if you meet these three requirements, criteria, you could also benefit from the same tax regime for cure-ups. There is no specific change, except maybe the difference is that depending on where your cure-ups is based, mm-hmm. Of course, the double tax treaty agreement will not be the same. So, for example, a cure-ups in Malta, you need also to consider the double tax treaty between Malta and France.
Sure. Okay, thank you. We have also had a question that's come through in relation to the assurance fee. Have there been, or would you consider there to be any, they're asking if there are any benefits of having a joint policy as opposed to two single ones? I can say, first of all, from a financial planning perspective, there are a few things that should be considered. One, the charging structure. It may be simply more cost effective to have one policy as opposed to two. Should also be considered from your objectives, investment objectives, attitude to risk. If you've got two very independent and separate approaches, then it may be more appropriate to have two separate policies as opposed to have everything in one. But Sarah, what are your views from a taxation perspective? Are there any benefits there to having two independent single life policies, or having it held on a joint life basis?
It's important first to remind that even for joint life insurance, the beneficiary will still benefit from the allowance of 152,000 euro. And then the main interest for the joint life insurance under tax perspective is that there is a settlement on the second death, which is not, which doesn't visit the tax precedence of the life insurance. So it means that you could keep the years of the duration of the life policy and benefit from the tax system. Mm-hmm. As we mentioned before, the payments done after 70 years on a life insurance contract are subject also to tax. And if the surviving spouse was under 70 years old when the co-subscriber payments, membership payments were made, the taxation is more at the end advantageous for the beneficiaries.
Sure.
Yes, basically. But yes, there is an interest to have a joint life insurance policy.
Okay, good. Thank you very much. So yes, for any of the other questions that we came through, I think that's all we've got time for today, but we will come back to you separately on that. And yeah, a lot of the information that we went through today, obviously it's fairly generic. So please don't take this as advice to do with your own personal situation. If you have specific questions in relation to your own situation, whether it's from a financial planning perspective or a taxation perspective, then obviously Sarah and I would be more than happy to speak with you individually on this. So thank you very much for your time today, Sarah, and thank you all for joining.
Thank you.